Curious about what's going on with the Fed rate cuts and what it means for your investments? We've seen a big shift from the rapid rate hikes of 2022, and now with inflation cooling and the job market slowing, the Fed is changing course. But what does that mean for you as an investor? Join me as we dive into the economic conditions that led to these rate cuts and why keeping a long-term perspective is key. We'll explore the ripple effects and what you need to know to stay ahead of the game. Let's go. All right, check out this chart that shows Fed rate cut cycles over the past 50 years. It might look like a tangled mess of lines, but trust me, there's a story here. Each cycle starts at zero to help us compare the Fed's moves over time. And you'll notice one thing. The Fed has been cutting rates a lot for all kinds of reasons. When the economy hits a rough patch like they did in 2008 financial crisis or the early 2000 dot-com bust, the Fed steps in, cutting rates to make borrowing cheaper and give the economy a jolt. It's like the Fed's emergency toolkit to keep things moving. But here's the kicker. Today's situation is a little bit different. The economy is growing, inflation is cooling off, and the job market is softening slowly. Nothing like the chaos of '08 or the tech bubble. Instead, it's more like the mid-90s, when the Fed fought inflation, then cut rates in what is often called a soft landing, basically saving the day without tipping us into a recession. Fingers crossed they can do it again. So why does this matter to you? The reason for rate cut changes how they impact the economy and your investments. Not every rate cut is a crisis move. Sometimes it's more of a fine-tune like we're seeing right now. All right, let's take a look at the job market with this chart tracking unemployment and underemployment rates. Now, while unemployment has ticked up a bit recently, it's still looking pretty strong compared to history. So no need to hit the panic button just yet. Here's where it gets interesting. The Fed has a tough balancing act called the dual mandate, where they try to keep inflation around 2% and make sure as many people as possible are employed. With inflation finally cooling down after spiking during the pandemic, the Fed is turning its attention to the job market, which is starting to show some cracks. The tricky part, monetary policy, basically the Fed's tools for steering the economy, works with a delay. Think like turning around a cruise ship. It takes a while to see results. But if they keep the brakes on too long, they risk slowing down the job market too much, which could hurt both businesses and families. So the Fed has to act carefully, aiming for that magical sweet spot where inflation keeps falling, but the job market doesn't get thrown off course. It's a delicate dance, and how well they could do it could impact all of us. So let's stay tuned to see how all of this unfolds. All right, here's something that always gets investors buzzing, the Treasury yield curve. This chart shows how the yield curve has changed over 3 key points: the latest market day, the end of last quarter, and the end of last year. I know it sounds like a lot of numbers, but hang with me here. Historically, lower interest rates have been good news for both stocks and bonds. When rates drop, bond prices tend to bounce back, and stock valuations can start looking pretty attractive. Right now, the bond market is already responding to the expected Fed rate cuts in 24 and 25. And for the first time since the Fed started hiking rates back in 22, the yield curve is disinverting. That's a fancy way of saying the short-term rates are falling faster than long-term rates, which gives us an upward sloping curve, a signal that the economy might be heading in the right direction. But it's not all smooth sailing just yet. As the Fed shifts gears in monetary policy, they're trying to strike a balance between supporting growth and keeping inflation in check. It's like walking a tightrope. You don't want to tip too far either way. And here's the kicker. It's not exact timing or size of each rate cut that matters most, but the overall direction of the Fed's policy over the next few years. So don't get caught up in the day-to-day headlines. Stay focused on the big picture. And remember, markets love to overreact, but smart investors keep it cool. Have a great day.